I'm very happy to introduce our next webinar here at Wharton Initiative on Financial Policy and Regulation, WIFPR. My name is Itay Goldstein. I am the director of WIFPR. And one of our leading products is to have this series of white papers and followed by webinars. What we do is we commission a white paper from an expert in the field to write about a topic that is currently on the agenda in financial policy and regulation. And we have a very thorough process to follow this white paper. We invite a roundtable with about 20 experts who serve as referees and comment on the paper and provide comments to the author. And then the author goes on to revise the paper. And with the final version of the paper, we do the webinar for public consumption. Today, I'm very happy to have Andreas Park from the University of Toronto. He has been working on DeFi and TradFi for a long time. He started from traditional market microstructure and moved into the new type of financial markets with DeFi. And he wrote a very illuminating paper contrasting the two and giving us some policy recommendations for the future on how we can facilitate DeFi better and have a better financial system that potentially combines both. So I will turn it over to Andreas to start presenting. We will have a 15-minute presentation and then follow up with Q&A. I will ask Andreas my own question and also take questions from the audience. So if you're in the audience, note that you can use the Q&A button to submit questions, and I will incorporate these questions into our discussion. So Andreas, the floor is yours.
Well, thank you so much, Itay, and also thank you to all the participants at the roundtable in May, where I got really excellent feedback on the draft that I wrote. So thanks for having me also here at this webinar. I'm really excited about this work, and I learned a lot from writing this paper. So let me maybe give you just a bit of an idea of why I wrote this and what I tried to accomplish here. So, obviously I talk a lot to people in industry. I talk to people in, my students. I give executive ed pieces, and there's a common theme that emerges, which is the question of what is really so different about this world of blockchain and decentralized finance, and do we really need it? So I thought I should try to use the approach that I've developed as a research on market microstructure, where we're looking at how the market institutions and market organization shapes market outcomes, and apply it here on a very high level, if you want. So the basic idea that I'm after is to say this, is that technology drives institutions and economics, more so maybe than we may recognize, especially as economists, but also maybe as people who are thinking of this space more generally. So the idea here is technology comes with limitations. It creates constraints, and those affect what can be done, how things are being done, and by whom they are done. And then the what, how, and by whom shapes the institutions, which are the rules of engagements that develop around this. You can think of this as regulations, if you want also, and then also the structure of the market and the I/O of the market, meaning that how firms and individuals interact, how they compete, and just how market outcomes are being shaped. And so what this paper aims to be is to be really some form of primer, and in some sense an excruciating detail, and it's quite long by now, about what happens, how it happens, and by whom it happens, contrasting how decentralized finance is organized from decentralized finance. And I hope that this is a good starting point to think more and deeper about the emergence of how blockchain could trigger some form of rethink of the industrial organization of financial services, and also the implications about the institutional arrangements, some of which emerge naturally and others we shape by policy and by law. So just very briefly, so the what, by whom, and how is essentially there's a technological constraint that leads to some form of service provision, and that leads then to some form of new market emerging. And alongside of the service development, we see that institutions form that in some form or other govern of how the services are being provided. if you think of it as a market economist, as a capitalist, is you're trying to set institutions in such a way that markets can really unfold their potential. So let me give you 2 examples of what I mean. This is very abstract. So let's start with something very simple, with money, right? So the core problem that people have is they want to keep their money safe. And if you look at the history of the emergence of banks in Europe with the Fugers and the Medici, it's really that they were there to facilitate also distant payments. So when you want to, when money has to travel across cities, banks were a way how to solve that problem. And so banks came along with their service offering, which was their vaults. And having money in these vaults gave rise to new markets, for instance, that of fractional lending. And around of all of this, we found it necessary to have regulations to make sure that the money is really kept safe, that the banks are not going crazy in terms of how they do their fractional lending and so on and so forth. So, but the core problem here that I'm after is to say, we had a technological problem, which is keep my money safe and arrange payments. And from that came a particular organization. Let me give you another example, which is trading or markets of financial contracts, the simplest, of course, being stocks. So when we want to trade, we need to be at the same space. So, in order to find a spot where we can all get together, we have development of exchanges. But we can't all be at the exchange at the same time, and neither can we be there all the time. And so that then led to the emergence of a new type of service provider, which are the brokers and dealers that are there at the market to facilitate trades for us. And with the emergence of these different parts of the market came new services such as investment services, data services, and so on and so forth. And there is a whole set of institutions that developed alongside this, regulation on conduct, access, disclosure, and so on and so forth. So, but again, here is the problem is it was a technological problem. We need to be at the same spot at the same time. And we found a technological answer to that, which was the emergence of a trading platform. Okay, so now let me apply that kind of thinking to, in a very broad way, traditional finance, and then also to determine and describe how blockchain and DeFi are different. And so the way, at the simplest possible and most reductionist way to think of traditional finance is to say that everything in traditional finance is driven by institutions or by intermediaries. So you have financial institutions, people act to and interact with their institutions, and then these institutions provide access to the market and to the financial infrastructure. But all assets are held with institutions or with intermediaries. And if you want to operate and exchange them in any form, you need to go through the intermediary. Now, in decentralized finance, with a blockchain, this fundamentally changes because the holding and operation of assets is precisely done by individuals directly, sometimes with the help of what's referred to as the smart contracts, which are codes or essentially pieces of code that are also operating on this infrastructure. But the key component here is really that the individual, if you want, is in charge. Now, throughout this paper, I take the extreme stance where I mean that a blockchain is a technology where people hold the assets in self-custody and where there's also free entry and unchecked entry, if you want, of service providers on this infrastructure. We can quibble over if this is the only way how you can think about it. There's different arrangements in blockchains and so on. But for the purposes of trying to be as clear as possible and to have the clearest vision of how DeFi works, I'm very restrictive in the sense of it is this thing, this self-custody, free entry type of model that I'm after. And so then let me summarize in a nutshell what really the differences are, what's special about a blockchain, which is it's a self-custody of assets, it's a self-determined access to the financial infrastructure, so that is without having to go through intermediaries. It's the free entry of service providers on these platforms. And if you want, also the provision of services which are fundamentally non-custodial in the sense of that the end user is in charge, subject to the conditions of how these services are being organized, but essentially is in charge of their assets. They never have to give over their assets and have somebody else do something with them where essentially the service provider is some form of black box. Now, I see these as features, but there's also very important direct implications or consequences of this, which is that a blockchain serves as a common resource for multiple parties to interact, and that services that are being provided on a blockchain conceptually are very close to platforms. And therefore, when you think of any operations on the blockchain, any business opportunities, it's important to apply platform economics as opposed to what we're sometimes think about of like two-sided as a customer and a service recipient. All right, now, how do these differences matter and what do they really do? So let's start with what I think is probably the most important one, which is the self-custody and the access to the financial infrastructure. So because the individual can take control over their assets and because they have direct access to the infrastructure without needing to go through intermediaries, fundamentally, intermediaries are no longer necessary. It doesn't mean that they will disappear, but they're no longer necessary. And so as a first step, you can say, well, okay, that's maybe a good thing because intermediaries do introduce a risk. Every time you have to go through an intermediary, you have to worry about conflicts of interest. If they actually have hold of your assets, you need to think about questions of can they abuse my assets, what happens if they disappear, and so on and so forth. But there's also significant downsides when intermediaries are no longer there. So for regulators, it becomes very inconvenient because they lose what's referred to as a regulatory hook. If for those of you who follow policy, you saw maybe a few weeks ago the proposal by the Democrats in the Senate for the Clarity Act, where essentially, you can see this in multiple different ways. But one way to think about it is that they try to reestablish a regulatory hook by putting some people, putting them on the hook, if you want. And I don't want to go into the politics of it, but all I'm trying to say is that with the absence of intermediaries, we're losing something. We're also losing some safeguards, we're losing some protections that are no longer available, and we have to think about how we can balance this out. Another part that we actually have to think about very carefully is privacy and compliance. So blockchains are by nature very transparent, and that could be a potential threat to individual privacy and also business privacy if you are, for instance, doing investments using blockchain. It's really something that you have to worry very much about. All right, now, if you think about the free entry of service providers, again, this is something which, in particular, regulators and policymakers may not feel so comfortable with, especially when it comes to finance and money. And there is really some maybe significant concern around it. But on the other hand, I also want to caution that we want to be mindful of actually the working of this environment. And I'm going into a fair bit of detail in the paper where if we're using a brute force approach, one of them is what's called sometimes whitelisting, is we need to worry about that we also may be tampering with the functionality of the system as a whole. And so sometimes maybe the cost of solving one problem is not worth the price that we pay because of the inefficiencies that we can create in the process. Now, one important question is probably for intermediaries and financial institutions of how do you handle this environment? I told you on the last slide that intermediaries are no longer necessary, that a blockchain is a common resource, that services have to think of themselves as platform, and many financial institutions will go, wow, this doesn't sound very good to me, right? So first of all, I don't want anybody to come between me and my customer. This is sort of like one of the mantras of financial institutions. And so how do we handle this? What's the best way to do this? And maybe you see this here, you have the big fortress. Maybe I should just build a big wall and keep everything blockchain related out. And to that, I want to answer this. It's like blockchain will not get uninvented. So I picked a picture here. This is from the movie World War Z. I don't want to go into the plot of the movie, but essentially in the movie, Israel had the ability to pre-see and to anticipate that a zombie attack was coming. And so they built a huge wall and they were very pleased with them. But then the tiniest of errors essentially allowed the zombies to come in and destroy the whole thing. So with that, I want to say the technology is not going to go away. So I think it's better to develop a strategy around it. And I go into some level of detail of how financial institutions could engage, what level of service they want to have. Maybe I should go straight to the very bottom here at the very bottom, which is, what is the way how a financial institution can operate on this, maybe by creating some form of layer 2 service provision in this environment. And we see, if you really want, the swift development of using an Ethereum rollup is essentially going that direction. Now, also, I want to say for people who work in this space, some things just won't change. There's some economic problems that are fundamental to market, and we need to be mindful of this also in the way of how systems are being designed. So a blockchain itself is not a market, right? We still have a need that investors and traders find one another to exchange. Issuers of financial contracts need distribution, so they need to find a way how to also find investors. Investors continue to worry about the same thing that they worry about in the old world. Information disclosures, information asymmetries, market manipulation, and so on. And to some degree, there could be more of it in the blockchain world. So, it's useful to have a good eye to this and to operate in this space with open eyes. Traders need to worry about liquidity, counterparty risk. And one thing maybe that is not being discussed enough in today's world is that as a society, we should worry very much about concentration risk. Because at the end of the day in finance, scale advantages are huge. One exchange has usually huge advantages over fragmentation of exchanges. If you have one financial institution that holds all the money that has advantages in lending out the money. So size really matters and scale really matters. And we have to worry about the risks that we're creating around that. Which brings me to some of the views on policy. Ultimately, this is a policy paper, so I'm going to pick a few of the items that I do discuss in the paper. This is not all that I have. So number one, I think this is, at the time when I wrote this, I thought this was relatively novel and not a widespread idea, but it has now found its way into the mainstream, is I think we need to think of the self-custody actually as such a fundamental feature that it needs to be preserved. It is sort of everything that gives rise to the change in the financial organization. I would argue in a good way, right? Because a lot of technological advances over history enable individuals to do new things, like the internet, cars, individual transportation, and so on and so forth. So I think this is worthwhile preserving. I think we need to think really hard about privacy and also maybe the Bank Secrecy Act. We need to be open to allow creative destruction. We just had a Nobel Prize, of course, on the topic. The more popular wording is, of course, we want to allow innovation, but really what we're after is we want to allow creative destruction, right? And so to do that, you need to be, more constraints are not a good thing, right? So you want the innovative potential to be unfolding itself. We want to maybe think also about enabling self-regulation and compliance incentives rather than forced compliance and forced regulation. That may be a better way forward, in particular for something that's relatively new. And lastly, I do want to caution that we shouldn't embrace permission systems just because they feel more comfortable because somebody is in charge. That alone may not be a positive. Okay, I'll stop at this point, and I thank you very much for listening.
Thank you, Andreas. Great presentation and great paper. So we will now move to the Q&A stage of the webinar, and I remind everyone in the audience that you can use the Q&A button to submit any questions that you may have for Andreas, and I will get started here and then incorporate some of the questions in my discussion with Andreas. So Andreas, I think you talked a lot about the current financial system and how the DeFi, the decentralized financial system, is trying to be different. But of course, very well that the current financial system developed over time and in some sense is now addressing a lot of the problems that came up over time in trade, in exchange, in money, and all sorts of things like that. So are you worried that maybe we are moving too fast here and we are going to design a new system that is really not going to be capable to address all these issues that we experienced in the past?
It's a really good question. Obviously, our world is what it is, and it works reasonably well, in particular in developed countries like the US and in Canada. Now, we can quibble over whether or not maybe we see increasing concentration there, and we see maybe some inefficiency there. But the moment you move into anything cross-border, it becomes difficult. The moment we think about somewhere outside of the developed world where we are, it becomes more difficult. And I think, it's a little bit of an old trope, but I think there is some advantages to decentralized finance in the sense of that it allows the opening up of some of the opportunities that we have in the developed world, moving to the rest of the world. But I can also take another step here. So now this is not so much, I spend a lot of time talking about trading and assets and so on. But if we just go to the very basics of money, let me give you a counterpoint. The old-fashioned way of how we think about our money and finance is, you give your money to the bank, and then the bank provides you the safekeeping of the assets and payment services. This is really why we have banks in the first place. But we also have to make the deal where you give a bank your money, you're becoming essentially a creditor to the bank. And is that really the best arrangement that we can have? It's an arrangement that we have that works. I would argue maybe China and India actually don't have it in the same manner, right? Because they do a lot with fintech companies like Paytm and Alipay and WeChat Pay. So they have a very different organization there. And so the thing I'm trying to bring up here is that banks also have a huge amount of money that they derive today from payments, which essentially is a tax on transactions. And you can argue whether or not this is actually the best way to do it, if this is really peak banking, or if there is a better way to do it. So I think blockchain provides an alternative. I don't think it will replace the way how finance works, but I think it's worthwhile seeing how it runs alongside of it.
So I'm following up here with a question from the audience that is related to what we just discussed. And it goes as follows. While self-custody and unrestricted access may be feasible in theory, empirical evidence suggests that the vast majority of users prefer to rely on intermediaries, which closely resemble traditional financial intermediaries. So when you consider this revealed preference, does this lead you to revise your beliefs about the need for decentralized finance?
That's a really good question. So there are different ways how you can, even within the blockchain world, how you can organize intermediaries. So it is entirely fair to say is how do people actually hold their crypto assets? Well, they go to Coinbase, Kraken, and Binance, and then they hold their assets with Coinbase, Kraken, and Binance. They actually do not actually use directly the Ethereum blockchain and the like. They keep their assets where they are. And this is fair. So it is difficult to say how people will do it going forward. Once maybe some other service opportunities emerge in this world. And I want to be cautious in extrapolating too much from existing behavior to what is possible in the future. So let me give you maybe a bigger version of a vision of how you can think also of something like a Coinbase developing in the future. You can entirely imagine that Coinbase, maybe a year or two from now, instead of operating as it is now, which is essentially a server sitting on top of a blockchain, it could be integrated by running on Base, its layer 2 solution. So all the trading runs on Base. And that means that people can move assets in and out of Base as opposed to having assets that they have to essentially give to Coinbase in custody. Once you do that, you're already much closer to how the blockchain operates in principle. You may have to take advantage of the speed of transfers, the speed of moving money around, and so on and so forth. And it also gives you in particular an easier and a faster way to just take funds and move them from one entity to another. Now, I'm not sure if this is a very satisfactory answer, but I would like to say this as I like to give people options. So.
And I guess related to that, so do you see some of the acquisitions that Coinbase is now doing to expand its services? Do you see that this is going in this direction?
So I don't know exactly all of the acquisitions that I have been doing, but I would imagine that they're at least discussing doing it this way. It's always a little tricky, right? Because if you take a position and put yourself in a position where you become really market dominant, changing in such a manner that you become more open to competitors and and allow competition in is hard, right? Because you're making so much money now, will we not be losing money by doing it differently in the future? There are examples where firms, even in the traditional internet world, have gone that way. But I think if you think of a place like Coinbase, thinking about a broad spectrum of service offering is probably the right approach, right? Because I think there are specialists, then there are specialist firms, for instance, like wallet software, for instance, or money transmission services that are just focusing on a particular aspect that is not in the mainstream of what Coinbase has been doing so far. So that an acquisition there may make perfect sense.
So picking up this theme of centralization versus decentralization, the way I think about fintech and clearly DeFi, there was this idea that we want to make the financial system decentralized because we don't like large players that are exposing us to systematic risk and potentially extracting rents and limiting the competition and so on. But then what we see now with the evolution of DeFi and I would say even fintech more broadly is that we do see the large players, and they come in all shapes and forms. Some of them are from the traditional financial system that are operating in the new financial system, and others are maybe new financial players that emerge and are potentially becoming big. So where do you see the equilibrium going here?
That's a really good question. And very honest, I think for those of us who are really deep into this whole DeFi space, there's a huge concern about some of the development. So I pick out two, Stripe and Circle with their offerings, Arc and Tempo. Essentially, both of them want to build the blockchain for which becomes the worldwide payments infrastructure. And I try to put this also to some degree on the slides and also talk a little bit about it in the paper. I think this is a little bit of a worrisome development for a very large number of reasons. Ultimately, these will be permission systems. Early on, they will be very collaborative and invite everybody in and build on their platform. But eventually, we're coming to the point where they ask questions about how can we extract the most rents from this. So it's not going to be like a public utility. At some point, it's a business. And, they're going to make arguments like, well, we have to improve it. This is costly for us to run and so on and so forth. And then all of a sudden you create one big entity, one big tech company that runs the entire payments of the world. That could be phenomenally profitable if you can pull this off. And it creates a huge systematic risk and systemic risk for a large number of reasons. It could be subject to political pressure. It's a huge cyber risk and so on and so forth. So those risks are real, and I think this is something that we should very much focus on and worry about. Now, I am a big fan of blockchain, obviously, and in particular, I am a big fan of the credible neutrality of it. So I see something like Ethereum is built essentially with the idea of all that we're trying to do is here's code and we're running the code. No matter what the code is, this is what we do, and we do this in a reliable way. And in that sense, actually, if you think of Ethereum is such a phenomenal beast and phenomenal innovation of that this network has been running for 10 years, essentially without being hacked, essentially without a hitch. So, it's as a public infrastructure, without government support, without the support of a large tech company, this is just extraordinary.
But you're somehow saying that maybe there will be new centralized players, central players that are going to emerge, but are somehow going to behave better than central players that we had in the past in the traditional financial system. The question is, how much can we push this argument?
Well, it's a good question, and this is actually a core question. So if you take a step back, what would be the most efficient, fastest, and easiest to operate financial infrastructure? Well, this would be one gigantic database that can run everything, right? I mean, there's no question that would be the most efficient way to do everything. But we can see there's lots of problems with this, right? So it starts with national problems, like we in Canada would not want it to be run in the US for now obvious reasons. Large institutions, will JP Morgan agree that Bank of America is going to run it? I don't see that either happening. So I think the centralization there is already something which is contested. And in a sense, actually, a blockchain which is credibly neutral is the next best thing to the system, except that it does not have maybe the super high throughput and the service provision and the phone number that you can call if you have a problem, right? But as an operational technology, it can do all of this. Now, when it comes to the emergence of something like Stripe with the infrastructure, there's a question of whether or not other firms will sign up on this or not. And this is obviously up to market participants, and it will be firms that have to sign up on it, not so much individuals, but firms. And also maybe the regulators to look into how this operates, and we'll see how this emerges. Now, Stripe and Tempo's, Stripes and Circle's approach is not the first, right? So we had the Libra network in 2019 that essentially tried to do the same thing. And in many ways, what Circle and what Stripe are doing is just a rehash of what Libra did. And that was very soundly rejected, though, by politics and policymakers. And I'm interested to see, and I'm not sure if this will be allowed this time around, when Stripe is the main player as opposed to Facebook. But I think as individuals and economists, though, we must be mindful of the risks that are being created and the trade-offs.
So another important thing to worry about is illicit finance. You talk about it a fair amount in the paper. And of course, there is an important tension here, because if you want to have self-custody and you want to have anonymity, then it's very difficult to fight crime and have all these implementation of regulations that we had over the years to fight crime. I think you mentioned in the paper that this needs to be taken very seriously, and participants in the new infrastructures should take this role and be responsible and so on. But the question is, how exactly are you going to enforce this, and whether what we end up having is really this policy trade-off? How far do we want to go into self-custody and anonymity, but then maybe sacrifice those safeguards?
Yeah, so first of all, crime is a major problem also in the blockchain space, and I wish that people would take this, who work in the space, would take it more seriously and would talk more openly about their wishes to stamp it out, right? Because I mean, nobody wants to have it to develop a technology and it being used predominantly by criminals. I think, the people that I know in this space that build it, they have absolutely no interest in supporting crime. And the part, of course, that we're really worried about when it comes to the usage of technology is that we provide scale for organized crime, and in particular also state actors. So with that in mind, it's important that we think of ways how we can address it without being overly restrictive, right? So there's, in any crime fighting, there's a tension between putting too much restrictions on the individuals and giving them their liberties, while at the same time keeping the bad actors out. Is this working in the banking world at the moment? Probably also not as well as it should be, right? So there's room for improvement there. And maybe we can think of a way how we can organize blockchain usage in such a way that we have actually stronger protections. So I'm waffling around here, but I think it starts with, is there a way how we can preserve our privacy in such a way that we have privacy of our transactions and privacy of who we are, while at the same time making it very hard for criminals to use the same system? And there are developments and there are tools that people have developed to combat crime. So one idea is, for instance, the proof of innocence, right? So you and I, we go to our financial institution, and we get authenticated that we are real people and that we are, benign people, if you want. And then the idea is that if you want to interact with certain services or certain assets, in order to be able to do this, we can prove in a particular environment, which could be linked to, say, something like Ethereum in a layer 2 solution, we can prove that we are the legitimate people that we are, and yet we have the ability to act in full privacy of our transactions. So it's not visible to anybody. And you can even have a mechanism in there which would allow this privacy to be revoked if, for instance, one of us does tend to operate in a criminal manner. Right. So, I mean, so there's somebody who has a PhD in finance from Warwick has actually developed a very interesting system there. It's called the Labyrinth Protocol, where he essentially tries to develop exactly that kind of idea. And so in a way, you can think about this. This could create more privacy of our transactions and keep criminals out even more effectively than what we currently have. So is this the ultimate solution? No, but it is one way how we can think about it. At the same time, I want to be a little cautious about this. So there is a brute force version that people also like to do, which is that of so-called whitelisting. Now, this is an approach which is much less deep, if you want, right? Because essentially you have to get your address, your wallet address, or your account, if you want, authenticated. And then you have transactions, say, where the tokenized asset can only work between authenticated addresses. This creates all kinds of problems because there would be privacy loss if you do this in the wrong way, where it's just basically a large list of transactions, creates honeypots of information. If you can get all these addresses, you can be able to link it to people. And you can create a lot of problems actually down the road there. So what I'm trying to say is it requires a very thoughtful approach and also requires an open-minded approach where maybe we do things differently, but equally effectively. So.
Okay, very good. If those solutions work, I think we'll be in a very good place. But as you say, there are clearly a lot of uncertainties still down the road. So one thing I want to ask about the government. So obviously you mentioned the government a lot because we need new laws potentially and regulations and all sorts of things to help facilitate this new financial system. But are you also thinking about the government potentially being even more active by developing some of the infrastructure, maybe developing some of the platforms and helping this kind of coordination? Are you going to go there or would you not go as far?
Yeah, I'm a little hesitant to be endorsing that. So how do I put this politely? There's a lot of very smart people that work in government and very well-intended people. I am less convinced that if you think about a financial infrastructure, fundamentally that is a market, right? And if you create and a market operates by who can provide services that work best. There's constant updating involved. And there's pressure to also deliver products efficiently. And governments have a very different set of constraints. They have a very different set of objectives. And it is not clear to me that a government would actually be able to develop a tool in a competitive environment that works well for individuals and for businesses. We can go endlessly over examples where governments have tried to develop what they thought was the best possible solution, which then spectacularly failed. So one example, the very first CBDC was developed in Finland in the 1990s. Now, not with blockchain or anything, but they had essentially pay cards where you could essentially load them with the equivalent of government cash. And that was rejected soundly by the market because it was just slightly too inconvenient to use. And there's many other examples for that. So with that, I would like to say is the best a government can do, in my opinion, is try to enable the market to develop in such a way that you actually have a proper market, right? To try to have only the restrictions that are necessary to create disastrous harm, but to otherwise let creative destruction unfold. Let the best system win, while also maintaining things like antitrust and over market concentration. Right? But building something yourself like let's say like a CBDC, there's a big discussion around this. There was a big discussion around this. I'm not a fan of that. Coming from Canada, I'm definitely not a fan of that. I'm a fan of our Bank of Canada, but given the experiences that we had over the last years, I'm very hesitant because I think you can use a government system also to great harm.
But of course, the tension is very clear once we think about the concept of money, because the government is issuing money And if you're now talking about the creation of private money, there will be some competition between private money and public money. We could go back to previous times where we had many different currencies and the singleness of money was under threat. So I think we need to consider more broadly what is the role of the government in all this. And you mentioned CBDC, but at the end of the day, one can view CBDC as a way to ensure that the fiat currency will remain as the dominant currency.
Yeah. But there's different ways how you can do a CBDC. I mean, it's entirely imaginable that you could create tokens on public blockchains as a government, and those become essentially the equivalent of government cash. So that's one option that is already there. Of course, in doing so, you have to give up some control. Just like with cash today, cash is essentially, if you want the most open access payments tool that exists. It's much less restrictive than any of the private monies that we use when we pay with credit cards and bank money, right? And I think this is actually a very good example of how a government has created technology, aka money and banknotes, that really facilitated growth in an economy. So yeah, kudos to governments then. If you want to go do the same thing in the digital world and put in the most possible restrictions, I think this is not conducive to actually working as well as it could be. Now, the singleness of money in particular when it comes to stablecoins is something that is often discussed as a problem. I'm not sure if this is on the retail level such a big problem. Of course, if you want to settle, $1 billion worth of treasury deals, then even the 10th digit of fluctuations in the price of different types of money is a problem. So there, for very large transactions, you want to have something like if you call it a wholesale CBDC. I'm not yet sure if this privately issued money, as it is currently done, let's say under the Genius Act, is going to be that big of a problem. To be quite frank, if you think of how the money is being created, let's say under the Genius provision, it's pretty close to money on a narrow bank, which is probably the safest type of money that you can envision. And the CBDC would not look very different, right? If you create a CBDC, right, what is it? A CBDC is still backed by a T-bill out fundamentally underlying it, right? So what does the Genius Act do? It essentially does the same thing, right? So I think the singleness issue may be a little bit overstated. I think we have to see how it unfolds. Just as a very small part here, if you go to the UK, right, so you have money in Scotland. The pounds in Scotland is different from the money issued by the Bank of England, in case you don't know. So Bank of Scotland is not a central bank.
Yeah, so we're coming close to the end here. I want to ask you one final question. So one of the concerns people may have when looking at DeFi right now is that it is pretty limited in what it can do. So you can trade one cryptocurrency against another, and you can use one as collateral to borrow another, and so on. But it hasn't really penetrated into kind of the mainstream of the financial system very much. You do talk about it a little bit in the paper, but I think overall a lot of people might view this as a disappointment. My question is, how do you see it? And if you had to guess where we are going to be in 5 years, what would you say?
Well, I think this is an entirely fair point, right? At the moment, people use blockchain mostly to trade one token against another token, and the value of these tokens beyond the blockchain world is often very limited, right? So if you want to put it like this, it's like the DeFi world currently doesn't finance any operations that are not DeFi. And since this is a limited, sort of almost like a closed environment, this is obviously not as far as it could be. I think tokenization will change this, and I think we will see that many assets will be finding their way onto blockchain and use there in tokenized environments. And once you have that in place, actually some of the applications that have been developed just for crypto assets can be directly applied to traditional financial assets. And I think there's some real value in actually having seen the experimentation, if you want, and the multiple failures over the last 5 years in the DeFi world as a positive, because it allowed this experimentation to prepare for the release of the real thing going forward. So I think We will see with tokenization that there will be some changes. And I think there's great benefits to it. I mean, you have written on this, there's multiple people have written on how actually Will Zong has written on this. I've written a paper on how decentralized trading can actually possibly save investors a lot of transactions costs over time. So, and I just hope that we see some development there.
Okay, very good. So this is a very good note to end on. So again, thank you very much for writing this great paper and for joining the webinar, and hopefully this will have real policy impact going forward. So thank you everyone for attending, and see you next time on a WIFPR webinar.
Thank you for including me.